ahead here and get this all pulled up.
Sounds good. Since we are kind of doing a rolling start, I'll just say how
Yeah,
we met. Yeah, I met Paul in Houston, Texas at a capital raising summit with Hero Alliance, right?
exactly right. And it was an absolute
Yes,
pleasure getting to meet you there, Tyler.
yes, 100%. Paul was great. You gave a great presentation on behalf of Equity Trust. Even though Equity Trust kind of speaks, the name speaks for itself in the industry, but you were still very humble, even though your company has all these accolades. And I thought that was great, very approachable. So happy to have you as a partner in teaching my network more about SDIRAs.
Thank you very much, Tyler. Really appreciate the opportunity today here to educate. Something I'm very passionate about and very excited to dig into here today and really help demystify self-directed IRAs as a whole. And really speak to the tax advantages that come with them. What I want to cover today is how we can really stop needlessly donating to the IRS, but rather going ahead using these retirement funds strategically to help grow and compound wealth. A little bit about myself and about my role. So I do work for Equity Trust Company, although I do belong to a distinct division within Equity Trust, that being Equity Institutional Services. We were formerly known as Midland Trust Company up until August of 2023 when we were acquired by our parent company. That rebranding really started occurring early in 2024, and it's been a great acquisition since. We've really been bolstered by their support. We've been empowered when it comes to marketing resources and really going ahead and assisting clients. I mean, that was a huge undertaking in which Equity took to ensure that at the end of the day, clients who are in need of an SDIRA can be taken care of with a direct representative, and something that makes us quite unique in our industry. A little bit about Equity. I'm speaking to you here today in Sioux Falls, South Dakota. It's where we're chartered with the South Dakota Division of Banking, but we hold 3 other offices as well over in Westlake, Ohio, that being right next to Cleveland, Fort Myers, Florida, where a lot of our Equity 1031 exchange staff will reside, and then in Chicago, Illinois, where we have quite a few members, a part of our private fund custody team, helping assist single and multifamily offices and registered investment advisors alike. When it comes to self-directing retirement funds, no 2 custodians are created equal, and we differ quite drastically from a lot of other custodians in the industry. I'm sure you've seen a lot of different advertisements, let's say, with the Super Bowl coming up next month. You might see an advertisement from Schwab, a Fidelity, a T. Rowe Price, a JP Morgan, what have you. A lot of these very large custodians really differ from Equity Trust Company in how they're structured and in how they're incentivized. A lot of traditional custodians are concerned with assets under management, otherwise referred to as AUM. They are very interested in having you invest in their proprietary mutual funds, exchange-traded funds, and the like, because that's where they make their revenue and really where they're concerned with growing their business. And largely why many people have never heard about self-directing IRAs and self-directing retirement funds in nature, because this is something that's been around since the 70s. I mean, we're talking over 50 years that people have been able to go ahead and self-direct their retirement funds, but a lot of people are going to be stuck in that public-facing market because that's where their fathers invested, that's what their grandfathers invested, and that's all they know. But what really differs with us is our administrative feasibility. We have the ability to go ahead and get you placed directly into real estate, into a private placement, let's say into multifamily housing and the like. So many different broad asset classes that I'm going to touch on here later that can be used when it comes to retirement dollars. Now, a lot of those large custodians won't be able to help you get there. They don't want to service that segment of the market because it's outside of their business model and what they're looking to accomplish, which is why we came on scene 52 years ago to go ahead and help serve those investors who are looking to self-direct their retirement funds, who are passionate about an investment, and who don't want to be limited to a very short menu of those public investments. Now, what is a self-directed IRA? A self-directed IRA is an IRA just like any other. That term self-directed is a marketing term, truly, through and through without. It's going to be the same IRA with the same contribution limits and the same rules that apply to it, whether it's housed at our institution or another. Now, what's important, as I mentioned earlier, is that custodian. Who's going to be the one helping shepherd that placement of funds and ensuring it can be done in a timely, efficient manner? Now, when it comes to asset classes, there are many, many different kinds of investments that can ultimately be placed. Some of the more popular investments that we hold custody to with our $77 billion of assets under custody would be real estate property, real estate syndications, private equity investments, investments into venture capital, lending, whether that's through secured or unsecured notes, futures trading, foreign exchange trading, precious metals such as gold and silver, cryptocurrency as well. So there is just a wide variety of different investments that one can make with retirement funds. Now, what investments are you not allowed to make with that IRA, right? So when it comes to investing, that investment needs to have a fair market value. So you're not allowed to invest into, let's say, a collectible, an old hot rod, what have you, something that the IRS cannot put a specific valuation on. You would not be able to go ahead and make that transaction with retirement funds. The same is true of S corporation stock due to the initial tax advantages it already receives, and anything that would be federally illegal at this time, such as an investment into cannabis. Now, if anything like that were to change in legality, so would the investment criteria, right? But when it comes to your self-directing journey, it is imperative you have a custodian along the way. It is required by the IRS to have that neutral and that third party who is going ahead and helping assist you place those retirement funds into that investment of your choosing.
Question for you, Paul.
Please, Tyler.
Well, it looks like you're about to get into it now with the advantages of self-directed IRA. But I wanted to know, like, when would a self-directed IRA not be a good fit? You know, everybody's been used to traditional markets for a very, very long time.
Yeah.
So I'm wondering why people have been okay with that for so long. Out of sight, out of mind, it's on autopilot. With the self-directed IRA, people may be apprehensive about managing it, being in that driver's seat. So if you want to discuss that, or are we going to get into that later?
We could certainly go ahead and dive head first. So when it comes to who would not be a good fit for a self-directed IRA, first I want to call out investment amount, right? So typically those who are seeking to place an investment with a sponsor, with that being with an investment sponsor, let's use a syndication as an example. A lot of syndicators do have investment minimums when it comes to going ahead and subscribing into their fund or offering. First and foremost, you want to make sure you have enough retirement dollars to go ahead and place that initial investment into that offering. Typically, I'll see those windows anywhere from $25,000, $50,000, $100,000 when it comes to a minimum. So to start, you need to ensure you have that amount of retirement savings to even get into the deal. Outside of that, you need to have a deal that you're presently getting into. By no means would you want to go ahead and transfer funds from another custodian over to our institution just to have those dollars sit, because that's exactly what they would do. They would sit in an uninterest-bearing account and just be held. And nobody wants to do that. You're not beating inflation, certainly, and your money's not working for you at that point. So you need to have a deal, an active deal or offering, an active offering that you're looking to go ahead and get invested into at that time. You wouldn't want to say, let your funds just sit here and collect dust while waiting to go ahead and identify that investment. Another thing to be considerate of is is time frame and access to capital, right? So a lot of alternative investments typically have a lockup period. That time horizon of 3 to 5 years is an industry norm that I'll see time and time again over various asset classes when it comes to investing IRA dollars. So when you're looking to go ahead and make this IRA investment, those funds are going to get wired over to the investment sponsor, and that will be a hold period into where, even though you'll be receiving distributions, you won't have direct access to those funds. So if you need immediate liquidity, if you need those dollars right away in that retirement account, if you already have them earmarked, something to be highly considerate of when going ahead and exploring your investment journey with an SDIRA. But that being said, there's also many tax advantages that come with that self-directed IRA. And the biggest one by far is going to be compounding interest in the absence of taxation. And that's going to be through a Roth IRA, being a post-tax account. A traditional account is also advantageous in that it is tax deferred. So regardless of which account you're investing with, you're not paying capital gains tax returns. But my favorite being the Roth, because when you pull those funds out post 59.5, they're not being taxed as ordinary income as compared to a traditional IRA investment. So when you are along in your investing journey, a lot of individuals will consider to use their Roth IRAs when looking at private equity opportunities, because those opportunities come with the chance of a higher return, right? And if I can go ahead and place those already tax-free dollars into that higher return, well, now I'm going to experience compounding interest at that higher rate in a tax-free system, because I've already paid the taxes on that seed capital when going ahead and contributing to that IRA account many moons ago. Now, any type of retirement account can be self-directed, and we're going to get into those specifics here in the next few slides on the different types of IRA accounts and even the different types of accounts that can be leveraged and rolled into the IRA to go ahead and fund your alternative investment journey. Investment options also being a wide reason of using a self-directed IRA. You're not limited to those public markets, right? So you have the benefit of going ahead, getting into those private market opportunities, and really seeking a return that fits your investor profile. Administrative fees is another attractive portion of the SDIRA. Our clients pay flat fixed fees, and that's something they really appreciate, especially when they come from let's say a more so traditional quote unquote custodian, who will typically charge a 220 fee, which would be a 2% fee for all of your assets they're managing, and then a 20% performance fee on those returns they garner for you as well. On our side of the house, what you would expect to pay is $555 in first year fees and $350 annually thereafter for our custodial fee. So when it comes to those investments you're making, it typically is much more nominal when it comes to cost of going ahead and using that vehicle. And then, of course, diversification. That's a huge reason people will explore self-directed IRAs. By no means does an individual have to do a full rollover of funds from their 401k or even a full transfer from their IRA. In fact, I experience quite the opposite when working with investors. They're looking to take a portion of their account over, not all of it, to make sure that they remain hedged. And not only the public markets, but now the private markets as well. That way, they're not on a roller coaster. Over the past year, we've all seen the stock tickers go up and down, and it is a roller coaster. A lot of Americans do believe that a lot of those top stocks are very overinflated right now. There's been many articles written on the AI bubble, many soothsayers predicting when that bubble is going to burst, and even investors, such as those who have shorted things in the past, have now begun to short those stocks as well. Tyler, please.
Yes. So having spoken to a couple of different SDIRA custodians, the fee thing is something I want to really harp on and make sure people understand. So no matter how big your SDIRA account is, and no matter how many investments you have, the flat fee of $555 first year and $350 annually is a standard
It will be, and that is $350 per investment.
per
So
investment. Okay.
it is a flat fixed fee, but it is per. Now, say that investments, say your IRA account value with us is $5 million, we're still only going to charge you the $350 per deal you're in, regardless of what your total portfolio size is. So we're really looking to go ahead and help people get placed, and we're not trying to hamstring people into making large investments. And we want to make sure that they can go ahead and make that investment regardless of size with that investment sponsor.
You said you don't need to transfer your full retirement account. You can stay in traditional markets and get exposure to other assets as well.
Exactly right, Tyler. And frankly, that's what a lot of those other custodians do very well is public markets, right? That's what they've built their empires on the past decades, is really going ahead and researching and developing and creating some of those proprietary funds that they do have some level of success with, right? So when it comes to investing, nobody ever wants to put their eggs all in one basket, right? If they do, they have a very high risk profile, and they're not me. That's for sure. But when it comes to investing, you want to make sure that you are diversified, that you do have your holdings in many different areas, so that if and when the market does turn, you can experience an upside with it. But should the market swing down, you're not losing everything in your retirement account all at once, as many other Americans potentially could. So you're exactly correct, Tyler. You do not by any means need to bring the whole chunk over. Most investors will typically just piecemeal it investment by investment, and that is when they'll go ahead and transfer funds. When they're working with that investment sponsor, when a capital call is due or a new offering presents itself, that will be when they will go ahead and transfer existing funds over into our account to go ahead and place those investments. Now, what happens when those investments come due? Say they make that investment, they yield a great return. Let's use hypotheticals. Say they placed a hypothetical investment of $100,000, 3 year passes, they're made whole. Let's say $175,000 flows back into their account. They can so choose to sweep the account after funds have all been sent back here to us, push those all back to their traditional custodians, well within their right. These are their retirement funds to do with as they wish. So by all means, after making that alternative investment, they could completely move those holdings after they've been liquidated, after they've been made whole from the investment, and transfer them back out to their current custodian in that more traditional segment. Or what most investors will do is either continue to reinvest those returns or sweep those returns and reinvest the principal amount into another alternative asset investment. Many different strategies used at that point in time, but certainly well within their right. Another piece I want to touch on in this diversification as well is, and even why people may not self-direct or may not understand about self-directing, is that incentive, right? When it comes to some of those traditional custodians, they do receive that asset under management fee, typically of 2% for all holdings. So when an individual investor wants to go ahead and move some of their retirement funds, occasionally a financial advisor may have a discussion with them based on risk, right? And at times it appears that it isn't coming from a fiduciary sense, but more so from their pocketbook sense on what they're commissioned and how they're compensated. So something for individual investors to be cognizant and aware of it. In addition, is that a lot of financial advisors do not enjoy when those funds are pulled out. Now, if you're working with a very successful financial advisor who understands holistically his role as a fiduciary and to go ahead and serve his client and to meet their goals and to meet their profile, he or she would have no issue in going ahead and doing so, right? But something I want to make people aware of today here as well is that may be a conversation that's brought up during this IRA transfer direct rollover process. But another reason is people simply forget. Many Americans change jobs every 3 to 5 years now after COVID. And due to that, when they separate from their employer, the 401k funds do become eligible, but many people forget. And they even forget where they house them at. So at times in the hustle and bustle of life, sometimes those investing priorities sometimes take a back seat. Now, we really touched on diversification today, but I want to continue speaking on that job change piece, because that is typically, more often than not, when somebody will pick up the phone and give me a call, is when they separate from their current employer. At that point in time is when that active 401k, let's use it as an example, you now separate from your employer, becomes a former employer 401k. You are now able to go ahead and direct those funds at your discretion. So what a lot of individuals will go ahead and choose to do would be known as a direct rollover, where they would move those funds from that custodian over to our institution, where they can now go ahead, place them into an IRA, and make that investment into that alternative asset. And another reason is illiquidity. Many investors, serial investors at least, typically have made all their investments by quarter four, right? I mean, they've already gone ahead, they've picked their horses, they've placed their investments. Well, now maybe they don't have that additional 100 grand to write out of their checkings or savings, right? Well, here's another way they can get into the deal, and a deal they believe in, doing so with tax advantage dollars. And then, of course, the mitigation aspect. You're not paying capital gains taxes on these returns. These are your most tax incentive investment dollars that you have access to, which is why a lot of people will go ahead and consider these syndication and private equity opportunities once they're presented to them. Now, I want to cover the types of accounts that can be used to go ahead and fund an IRA. Many different ones, and I want to speak to even ones that aren't on the screen here today. A thrift savings plan is going to be unique for those uniformed guard members. So think of those in the serving our country. They're going to have access to that thrift saving plan. Once when they separate and become a veteran is when they have access to go ahead and do that direct rollover and place those funds into an IRA. A 457B is going to be another example, reserved for those at the government, state, and local level. Think of like your local mayor or councilman. They would have access to that 457B. A 403B is going to be typically reserved for those going ahead and working in the education system. So think public school teachers are going to have access to those 403Bs. Even qualified annuities are able to be rolled over into a self-directed IRA as well, and many types of defined benefit plans. A 401k is going to be one of the more popular types of plans that people are familiar with, and those are going to be for those who work in businesses, in industry, who are going to have access to that 401k. As I mentioned, most people don't have access to those until they separate from their employer. But at times, those 401k plans allow for what's known as an in-service rollover, which would be a rollover while you still have active employment with that employer. It is typically the exception and not the norm. But some policies do specifically allow for it. And something I would always encourage an investor to do is ask their 401k plan administrator if an in-service rollover is possible. The worst case scenario they're going to tell you is no. And at that point, you're in the exact same seat you're in today. Tyler.
Right. Are there any specific plans that are eligible for in-service rollover, or any specific custodians like that you've experienced in your time with Equity Trust?
Yeah, so there are actually a few requirements I've seen written into some of these plan policies. Some have to do with length of tenure, right? So some 401k plan policies are written that you have to be with the company for X amount of years before you're eligible to go ahead and do an in-service rollover. Another one I've seen specifically is you need to be at least 59 and a half. So you have to be at that age of distribution before they'll let you go ahead and do that in-service rollover. So I have seen some of those requirements come up when it comes to those individuals who were allowed to do an in-service rollover. That being said, it's a question worth asking They tell you, no, you're in the exact same seat you were in yesterday, but I want to manage people's expectations and that it truly is the exception and not the norm.
Thrift savings account. So you have to be done with your service in order to self-direct that account.
Correct.
Okay.
Other IRA accounts can seamlessly be moved over via transfer to transfer. So any IRA you currently hold can get moved over here, regardless of what custodian it's currently sitting in. And I want to take time to go ahead and speak to those different accounts today. A traditional IRA, it's going to be a pre-tax account. There are some tax deductions based on what your earnings look like for that current year. Although most investors I do work with, unfortunately, would not qualify for those tax deductions. With the traditional IRA, it is going to be taxed at the ordinary income rate once when you start taking those distributions post 59.5. So once when you start pulling those funds out of the account, that's when they're going to go ahead and be seen by Uncle Sam as a little bonus you made. And it's going to be added when you go to file on April 15th to your ordinary income. So it's important once when you're starting to take these distributions post 59.5 that you start working with your CPA. Because the last thing you would want to do is to go ahead and take a distribution out that would bump you up into a higher tax bracket federally, where all of a sudden I'm not getting taxed more just on that distribution amount. I'm getting taxed more on all of my earnings for the current year. So really important once when you start taking those distributions out electively at 59.5 to get with the CPA, or just to go ahead and assess the tax code to make sure you're not going to accidentally bump yourself up into a higher tax bracket when taking that distribution. That being said, at age 73 is going to be the age where required minimum distributions are going to start taking effect. So that's when Uncle Sam's going to tap you on the shoulder and start saying, okay, we're going to start taking funds out of this account because I need my tax money. So that's when the government's going to start creating taxable events for you, where you're going to have to go ahead and pull out a minimum amount every year as required by the IRS. Now, the Roth IRA is one of my favorite accounts, and it is because you're allowed to have that post-tax position. Now, another attractive thing with the Roth IRA is you can make withdrawals from contributions after 5 years, tax-free and penalty-free. So if I go ahead, contribute to a Roth IRA, fast forward 5 years, I can pull that Roth contribution out without taking tax liability, right? Or without taking penalty liability, which is an attractive thing when we're talking about liquidity, right? Now, keep in mind, when you're making this alternative investment, you're only able to pull out the dollars that are in your account, right? A lot of these alternative asset investments do have a lockup period of 3 to 5 years where those funds will get wired over to the general partner and be used to invest, right? So you need the funds in your account to pull out. But another very cool thing about the Roth. Now, with the Roth IRA, there is modified adjusted gross income limits for it. But people have been getting around this now since 2010 legally through what's known as the backdoor Roth conversion. Simply, you would go ahead, contribute to a traditional IRA, do what's known as a Roth conversion, take the tax hit on the amount that you're converting over, but seamlessly push it into a post-tax account, even if you're above the income limit, to directly contribute to the Roth IRA. An awesome lever to pull once when you're really earning a good amount of income. For the SEP IRA, that's going to stand for the Simplified Employee Pension Plan. Now, the SEP IRA is going to be pre-tax, very similar to the traditional IRA, and it's going to be reserved for business owners. With those of 25 employees or less, the contribution limit is going to be a lot greater. It's going to be coming in at 25% of compensation up to $72,000. So it is a way to really turbocharge that tax savings, the retirement contributions. A simple IRA also going to be reserved for business owners, also going to be a pre-tax account. Now for the SEP IRA, for the simple IRA, this is going to be for businesses with less than 100 employees. So you're able to go ahead and get access to it, even if you do have more employees than those 25 or more. But with the simple IRA, those contribution limits are going to be smaller, sitting around for 2026 that $17,000 range, or you're able to do what's known as a catch-up contribution if you're over 50 or 50, getting you to that $21,000 threshold. And then I also wanted to speak to inherited IRA accounts. Inherited IRA accounts, you're not allowed to contribute to them, but you would receive them if you're named as a beneficiary on somebody's account. So if somebody were to pass, you could go ahead and inherit that IRA. Now, an important thing to be aware of, if you're a non-spouse receiving it, so let's say it wasn't my spouse that had passed, but somebody else, I would have a 10-year timeline where I would need to distribute everything fully from that account. So when I receive that account, I have a 10-year ticking window into which I need to have everything pulled out of that account after, which is important because you need to prepare, if it is a pre-tax account, for those ordinary income taxes that are going to be had as distributions. Now, let's say a spouse inherited the account. They can seamlessly go ahead, transfer their funds into their own account, and then take hold of their retirement funds. So that 10-year window isn't going to affect them when it comes to that inherited IRA. Now, there's also something known as a solo 401k. This is going to be another type of plan that you're able to go ahead and self-direct, although the solo 401k is more intensive when it comes to eligibility requirements and those who qualify. For the solo 401k, you need to be a business owner, but you're not allowed to have any common law employees. So you're not allowed to employ anybody outside of a spouse. A spouse would be the only exception into who else is working in that business for you. But a great thing about the solo 401k is you're able to go ahead and have a huge contribution limit, but do so with post-tax dollars, those being with Roth dollars, right? Really creating that snowball effect. And there's two other accounts I want to call out as well. An ESA, an education savings account, otherwise referred to as a Coverdahl education savings account, from Senator Coverdahl, who went ahead and enacted it. But this is another thing that can be self-directed that most people don't know about. They typically use them for their children, those needed education expenses, think books, tuition, room and board when in school, right? Some of those things are what they are typically used for. But let's say your son or daughter is on a full ride scholarship, right? Let's say they're a national merit scholar. They have all of that taken care of. Another way you could go ahead and self-direct funds. And those are going to be post-tax, similar to the Roth. An HSA is another account, that being a health savings account. Typically used to pay for those medical expenses, used to go towards a deductible, buying prescription medicine. I think even such things such as like weights qualify for that as well, right? Lots of different things that qualify for that HSA, especially when you're able to get your doctor to write a note on it. But I've actually seen many investors use these to fund real estate syndication investments, and those with healthy families, right? Say you're contributing that max contribution, which is $8,750 this year if you have a family, and let's say you luck out. Let's say the kids are healthy this year, you and your spouse stay in good health, you're an active family, you run, lift weights, what have you. You can actually go ahead and self-direct those funds as well, and certainly something we can go ahead and help assist you into going ahead, creating that self-directed vehicle to go get those placed. Now, here are some considerations when using your IRAs, right? Some things that you need to be aware of and need to be on the lookout for. As I mentioned earlier, you need to use a custodian. It's not an option. The IRS does require it. Another important thing to annotate, the investment's going to be made by the IRA, right? So it's owned by the IRA. Due to that, we'll need you to go ahead and endorse on behalf of your IRA. So just something important to be cognizant of. It's not you personally making the investment. The IRA is the one doing it. Cash flow needs to involve custodians. So money in, money out, we need to be involved, whether it's a contribution, distribution, or the like. Lead time. It typically takes a few weeks to go ahead and not only create the account, but receive funds from that institution. An IRA to IRA transfer typically takes anywhere from a week and a half to 2 weeks, where that direct rollover, let's say it's moving from an account outside an IRA like a 401k, that will typically be a 2 to 3 week process due to the fact that your custodian will actually send us a check and we'll hold on to the check so that it clears for 5 business days in our account before we go ahead and send the wire to get you fully invested. Active 401k money, as I mentioned, is typically off limits unless you do qualify for that in-service rollover. 3 simple steps. Go ahead, open the account with Equity Institutional Services, fund it, whether that's via transfer or rollover, and then go ahead and complete the investment. By far, I would encourage you to go ahead and meet with myself and our team so that we can assist. We have much experience in going ahead, helping pre-fill documents to make this as easy as possible for those individual investors. Tyler, I wanted to take a minute to take a beat here. Did you want me to touch on checkbook IRAs today?
I was really interested in all of those accounts. Like, I did not know about the health savings account opportunity because, again, that's you think it's limited for medicine and weight law, whatever.
Right.
And the fact that you can self-direct that into real estate is really cool.
No,
Really cool.
It's phenomenal, and I've even seen like individual investors bring over an HSA and like create a checkbook with it. So like the HSA owns outright an LLC, and now they're transferring funds from their HSA to that LLC bank account and then using the LLC to invest. So I've seen people get pretty deadly with those HSAs and those returns.
The HSA, it usually that money rolls over into the following year and the following year and the following year.
Yep.
Kind of thing. Okay.
So that account just keeps on growing and growing. And most people have it set up, Tyler, just like their 401k. So like I'll speak for myself. Like I have an HSA here through Equity. In every pay period, they pull funds out of my paycheck, deposit it directly into that HSA. So it continues to grow, even as it's invested, as I'm contributing to it on an ongoing basis, just like that 401k where it's getting earmarked every pay period.
In the rules for that one, do you have to leave the employer to self-direct the HSA?
Right. There typically needs to be separation.
Gotcha. Okay, that was really interesting to me, but we can definitely get into the checkbook IRA here in our last 15 minutes.
Perfect. Now the thing with the checkbook IRA, it's very similar to the self-directed. Checkbook is just a marketing term, right? So a lot of these custodians will really use it as a marketing term. What it really means is that you own an IRA that owns an LLC outright. And it's not just any type of LLC. It's specifically a manager-managed LLC, which allows for the sole owner to be the IRA, but it gives the account owner the signator powers to go ahead and close on any documents needed to complete their transaction. Now, a huge benefit to this is LLC protection. So specifically earmarking this for real estate property investors, right? Those who want to invest in a single family home, a duplex, they want to buy something that has a tenant in it eventually, or that has a lease going on. They want the checkbook IRA. It's going to help CYA in case their tenant, like here in Sioux Falls, right? We got about an inch of ice on the sidewalk right now. Say they slip, fall, say it's in the shower, what have you, you're going to be personally protected, right? You're going to have that limited liability protection veil, and also the ease of transaction. So with the checkbook IRA, you're actually going to have direct access to those retirement funds. Now, as Uncle Ben would tell Peter Parker, Spider-Man, right? Like with great power comes great responsibility, right? I mean, at the end of the day, this does have more responsibility placed on the individual investor, right? This, while it does allow for a more seamless movement of funds, that individual investor will need to re-register the LLC every year, for instance, in the state they're filing, because this is a real limited liability company. So something just to be aware of for those individual investors. But we can help make it easy on the front end, right? We can do the articles of organization, the operating agreement, registering for the EIN, doing the initial state filing, connecting the bank account through Titan, all of those things we can help with. And we can even help with going ahead and re-registering as well if the investor wanted us to do so in addition. An important thing to call out, it needs to be a newly created LLC with no prior business activity, right? And I'm a visual learner, so here's what that structure would actually look like, right? So, and let's even take it back a further step. Say funds are over here at another custodian. We would go ahead, do the IRA to IRA transfer, do the direct rollover, move it into that vehicle here with us, that IRA or that 401k. From here, we'd help assist, create that single member LLC, manager managed, and actually wire funds from our IRA account into that bank account that the LLC owns. From there, an investor could use that to write checks, to buy property, invest in the syndication deal, what have you, right? They could use it for all their real estate investing purposes. And it makes it really easy if they're leasing, right? Even if they're using like an Airbnb or Vrbo, they can set up that bank account. They can that LLC account can get directly paid and compensated for the rent. Now, important thing to call out, and I'll cover it here in some of these slides, is movement of funds, right? And in no instance would you want to commingle funds. You would never want to go ahead, send funds from your personal account to this LLC's bank account, right? Because we're talking about retirement funds that we're investing here that need to be kept separate. So if you were looking to make a contribution, you would contribute directly here with us to the IRA, have us send a wire or ACH over to that bank account, and then use it to invest. The same is true if you want to take a distribution. Say you're post 59 and a half, you got some grandkids, you want to spoil them, you'd go ahead, you'd take a wire or ACH from the LLC bank account back to the IRA here, and then take the distribution through us. That way everything's reportable to the IRS and all kept above board. With that investment account, that single member LLC account, it needs to be used for investing activity. You wouldn't want to use it to fill up your truck with gas, buy a cheeseburger, anything of the sort. You want to make sure that you're using it for those real estate investment activities. Other things I want to call out with this, you do have a lot more freedom when it comes to transacting because you're doing so with that LLC account, right? You're doing so freely. You can write a check on site, and that's where the checkbook IRA name comes from. Important to be aware of rules, though, when it comes to IRA investing. And the first one I want to call out are disqualified parties. So the IRS comes out right away and says, here are the people that you're not allowed to invest with. The first one's going to be yourself. So if I wanted to sell myself a couple acres of property I own, I wouldn't be able to sell it to my IRA because the IRS would view that as self-dealing, number two here, right? Another party that's going to be prohibited to me is my spouse, my wife. I wouldn't be able to purchase that land from her. Any of my parents and grandparents, so my direct ancestors, any of my direct descendants, their marriages and offspring. So any of my kids, any of my son and daughter-in-laws, any of my great-grandchildren. Now, who's on the table? What family members are left after that? My brothers and sisters, my uncles and aunts, my nieces and nephews, my first cousins, right? Or second cousins, third cousins, what have you. At the end of the day, the IRS doesn't think they're going to do you any favors as compared to those previously named parties. Also important to be aware, no manager fees, right? Even though you own this LLC, you can't pay yourself a fee for finding a tenant, right? You can't figure out a way to siphon money out of that IRA account into your personal bank account, even if you are helping find the tenant. That being said, when it comes to the property, you're not able to perform what's known as sweat equity. So let's say the roof starts leaking, you're not able to run up there, tack down shingles yourself, air conditioner needs to be replaced, you're not able to put the unit in. You need to go ahead and use a third party to go ahead and complete those. Because otherwise it could be seen also as self-dealing. You're providing services to the property that your IRA owns, and you are a disqualified party to your IRA. You can still find the tenants, line the tenants up. You can still call the plumbing company to come out and fix the toilet. You just can't actually get down on your hands and knees and and do it yourself, right? Touched on that individual responsibility, the re-registration process, if you'd elected to go ahead and do that yourself, and then personal oversight, right? I mean, you are the manager of this LLC, so you need to be keeping those credits and debits. You need to be holding on to those account statements and ensuring that you know what dollars are entering and leaving the account at all times. Very straightforward process. In fact, we're able to create that LLC and help with that bank account connectivity simultaneously as we're waiting for funds to receive from that current custodian. So really going to be close to that same time frame, that 2 to 3 week time frame, depending on how you're moving funds over. We're actually able to go ahead and help create that LLC simultaneously as we await for funds from your current custodian. I wanted to make sure to leave some time here to help open it up to a Q&A. I want to make sure I can provide value and help educate.
One question before we close: the prohibited transactions. We didn't talk about that until it got to the checkbook IRA, but a lot of those same prohibited transactions apply for all SDIRA investments, right?
Exactly correct, Tyler. So not only for the checkbook IRA, but for any IRA that matter, those are going to hold true. So really important when you're going ahead and making these investments that you're not investing with one of those family members that could be disqualified.
Gotcha. No, that was it. You covered everything that I wanted to cover, all of my questions, but I know the listeners are going to have a lot of questions, different nuanced. What about this? What if I want to invest in this? So I just want you to let people know how to reach you and how you prefer them to get their questions answered.
Yeah, the best way to reach me is direct. So you can always reach me at my cell phone via call or text, 605-799-8620, or you can reach me as well via email at my first initial P.Herbes at trustetc.com. And then I also have a calendar link out there as well that I'm sure Tyler would provide you with if you did want to go ahead, meet on a one-on-one session like this over Teams and help get some of those questions solved.
Absolutely. I will put all your information very accessible for everyone. Paul is our partner and partner to many other small businesses like Dynasty Growth Ventures. I cannot keep up with all the information, so I will definitely be passing off to you, Paul. Thank you so much.
Thank you, Tyler. I really appreciate the opportunity. It's been an absolute treat to join you here today, and I look forward to continuing our relationship. Thank you very much.